Hello everyone, today I'm going over the extra problems of chapters 13 and 14. Let's start with the first question. You recently purchased a stock that's expected to earn 30% in a booming economy, 9% in a normal economy, and lose 33% in a recession. The probability of a booming economy is 5%, 75% of a normal economy, and 20% of a recession. Because always the sum of probabilities should be equal to 1. So in this case, the expected return is equal to the sum of PI times RI. So in this case, I have the following: 5% times 30% plus 0.75 times 9% plus 20%, 0.2 times, in the case of a recession, I will lose 33%. So this is minus 33. The answer is 1.65%. So this is a direct application of the formula. The second question, I need to find the variance. So if the economy is normal, the stock return is expected to be 16.5%. If there's a recession, the stock is expected to generate a negative 11.6%. The probability of a normal economy is 80%. That of a recession is 20%. I need here to determine the variance of this stock. Now, in order to determine the variance, I need first to determine the expected return. So here I can create the table. I have two states of the economy. So here I have a normal economy and a recession with 80 and 20%. Normal and recession. PI 0.8 and 0.2. And here I have RI, the return. The return 16.5 and minus 11.6. So first of all, in order to determine the expected return is the sum of PI RI. So mainly I multiply each return by the associated probability and I add everything together. So here I will get for the expected return 10.88%. Now the formula for the variance is equal to the following: the sum of PI RI minus the expected return squared. So I need to compute the deviation or the difference between the return associated with each state of the economy and the expected return, square that value, and then I multiply it by PI. So here I will add RI minus expected return squared. So here I will have 0.165 minus 0.1088 to the power 2. Here I will have minus 0.116 minus 0.1088 to the power 2. I multiply the probability by the squared deviation for the two states. I add, and then I will have the variance. In this case, I will get a variance equal to 0.012634. So this is for number 2. Now for number 3, I need to determine the portfolio weight of stock C. So here I have a portfolio with 4 different stocks. I have the number of shares and the price per share for each of those 4 stocks. So in order to determine the weight, I need first to determine the value of my portfolio. So mainly, I multiply the number of shares by the price per share to determine my holdings from each stock. So here, if you want, I'm computing the market value of my holdings. So I have 500 times 14, 7,000, 200 times 23, 4,600, 600 times 18, 10,800, 100 times 47, 4,700. So now I add everything together. So 27,100, this is the total value of my portfolio. To determine the weight invested in stock C, so for C this is 10,800 divided by the value of my portfolio, 27,100, and the answer is 39.85%. So this is how we can determine the weight of an individual stock in a given portfolio. Of course, if I want to compute the values for A, B, and D, I have here to divide 7,000, 4,600, 4,700 by 27,100, which is the total value of my holdings or the market value of my portfolio. Now for number 4, you have a portfolio consisting solely of stock A and stock B. The portfolio has an expected return of 9.8%. A has an expected return of 11.4%. B has an expected return of 6.4%. I need to determine WA. How much money is invested in stock A? So here I will have the following. I have those 2 stocks. Here I will have the return, and here I have the weight. I know that the return of my portfolio is equal to 9.8%. The return on A is 11.4. On B it's 6.4%. So here I need to determine WA. So let's say that WA is X. In this case, WB is going to be 1 minus X, because the sum of weights in a portfolio is always equal to 1. So because WA plus WB is equal to 1, I can say that WA and here 1 minus WA, or I can use X. So this is 1 minus X. So now applying the formula for the return of the portfolio, I can say RP equals the sum of WI, RI. So I have the following. I have 9.8%, 0.098 equals 0.114x. So this is WA times RA plus WB 1 minus X times 0.064. So in this case, I have 0.114x minus 0.064x equal to 0.098 minus 0.064. So I have 0.05x equals to 0.034. X equals 0.034 divided by 0.05. This is 0.68 or 68%. So in this case, 68% of my money is invested in A, and 32% of my money is invested in stock B. Number 5 now. What is the expected return on a portfolio which is invested 25% in stock A, 55% in B, and the rest in stock C? So here, if I want to compute the weight of C, I can say that WC equals 100% minus 25 minus 55%. So the weight invested in C is gonna be equal to 20%. So now the formula for the return of the portfolio, this is equal to the sum of the product of weights times the expected return of each security. So the first step is going to be to compute the return of each stock. So here I have, let's say here I have the returns. So I need to compute the return of A, the return of B, and the return of C. So for A, so for each stock, I will have the following. The expected return is equal to the sum of PI, RI. So here for A, it's 5% times 19% plus 45% times 11% plus 50% times minus 23%. The return of A is going to be minus 5.6%. I do the same thing for B. I multiply 5% times 9 plus 45% times 8 plus 50% times 5%. Here I will get for B 6.55%. Finally, for C, I multiply also the weight, the probability times the return. So this is times 0.05. This is times 0.45. And finally times 0.5. I add everything together. I will get 18.65%. This is the return. Here I can add the weights. So let's say WI. Here I have 25%, so 0.25 in A, 0.55 in B, and finally 0.2 in C. I multiply the return of each stock, the expected return of each stock, by the weight, and I add everything together. So here the sum is equal to 5.93%. Therefore, the return on my portfolio is equal, the expected return on my portfolio is 5.93%. So for this problem, mainly, we had to go over two steps. In the first step, I had to compute the expected return of each individual security. Once I have the expected return of each individual security, I can apply the following formula and compute the expected return of my portfolio, which is the sum of the product of the weights by the expected return of each security. Now, applications on the capital asset pricing model. The first question is to compute beta of the following portfolio. Now, let me write first the formula. Beta of the portfolio equals the sum of the product of WI times beta I. So mainly, beta of a portfolio is a weighted average beta of the individual securities included in that portfolio. So the first thing that I have to do is to compute the weights, to compute WI. So in order to compute the weights, I add first the amount invested in each security. So I have 6,700 plus 3,000 plus $8,500. So here I will have $18,200. This is the total value of the portfolio. To compute the weights, this is 6,700 divided by 18,200. This is 3,000 divided by 18,200, and finally 8,500 divided by 18,200. So this is how I can compute the weights. In order to get beta of my portfolio, I multiply beta times the weight, and then I add everything. So the sum of the product in this case is going to be equal to 1.09, and I can say that beta of the portfolio is equal to 1.09. Now I move to problem number 7, where I mainly have the same given. So this is an extension of problem 6. So here I have the risk-free rate is 3.1%. The market return is 15.2%. I need to compute the required rate of return on the following portfolio, which is the same portfolio as in problem 6. The return on the portfolio is equal to the risk-free rate plus beta of the portfolio times RM minus RF. Now, mainly, you may face a question like directly question number 7. So let's say if we didn't solve problem number 6, in order to solve problem number 7, the first thing that we need to compute is to compute beta of the portfolio. So we need to replicate all the stuff we did in problem number 6 as a first step. Once I have beta of the portfolio, I can directly apply the formula. So here the return on the portfolio is equal to 0.031 RF plus beta of the portfolio is 1.09 times here in this problem I have the return on the market. So this is RM. So this is 0.152 minus 0.031, and the answer is 16.29%. Number 8, a direct application of the formula. So here I have RF is 3.9%. This time I have the market risk premium 6.2%. The market risk premium is RM minus RF. What is the expected return on a stock with a beta of 1.21? The return on the stock is equal to 3.9% plus beta 1.21 times the market risk premium, which is 0.062, and the answer is 11.4%. Now for number 9, the common stock of Jensen Shipping has an expected return of 14.7%. The return on the market is 10.8%. This is RM. The risk-free rate is 3.8%. This is RF. I need now to determine beta of the stock. So it's still an application of the CAPM. So I have the return on the stock is equal to RF plus beta into RM minus RF. So here I have 0.147 equals 0.038 plus beta times RM is 10.8%, so 0.108 minus 0.038. So I have 0.147 minus 0.038 is equal 0.108 minus 0.038. This is 0.07 beta. So beta equals 0.109 divided by 0.07, and the answer is 1.56. The final problem that covers chapter 13, you have a $12,000 portfolio which is invested in 3 assets, in stocks A, B, and a risk-free asset. $5,000 is invested in A. A has a beta of 1.76 and B has a beta of 0.89. How much needs to be invested in B if you want to form a portfolio with beta of 1.1? So here mainly you have A, B, and you have the risk-free asset, I will call it F. The amount invested in A is $5,000. The amount invested in B, this is X. The amount invested in F, this is $12,000. minus 5,000 minus X. So whatever remains is invested in F. Like I'm investing 5,000 in A, X in B. The sum of the amount invested in those two stocks minus $12,000, this is the amount invested in F, because here if I add everything I should have $12,000. Now that number here, which is 7,000 minus X, it won't matter much, as we're going to see later on. So this is the amount invested. So now if I want to determine the weights, here let's say I have the weight. For A, this is 5,000 divided by 12,000. I can write it as 5 divided by 12. Here I have X divided by 12,000. So this is the weight of B, the percentage invested in stock B. And finally for F, I have 7,000 minus X divided by 12,000. Now, the last piece of information that I have relates to beta. I have that beta of A is 1.76, beta of B is 0.89. I don't have beta of the last asset. However, because it's a risk-free asset, the risk-free asset has zero systematic risk. So beta of F is equal to 0. And this will simplify later on everything, that beta of the third asset is equal to 0. So now I have beta of the portfolio is equal to 1.1. So now the formula of beta of the portfolio equals the sum of WI beta I. So I have 1.1 equals 5 over 12 times 1.76 plus X divided by $12,000. This is the weight of B times 0.89. Finally, for C, this will end up to be 0. Like I will write it anyway. Here I have 7,000 minus X divided by 12,000 times 0, because beta of the risk-free asset is 0, so this will cancel out. So I will end up with the following. 1.1 equals 5 over 12 times 1.76 plus X times 0.89 divided by $12,000. So here I will have 1.1 minus 5 over 12 times 1.76. This is equal to 0.89x divided by 12,000. So x equals 1.1 minus 5 over 12 times 1.76 times 12,000 divided by 0.89. So computing that value, I will have X, which is the weight of B, the amount invested in B, I will have X equals to 4,943.82. Now I move to problem 11, the first problem that relates to the weighted average cost of capital. The first problems, they cover the cost of common equity, and here we will see the cases, the two cases, the case of the dividend growth model and the case that relates to the capital asset pricing model or to the security market line. Okay, so here we have a stock that's expected to pay an annual dividend of 0.8 a share next year. So this is D1. The market price is 19.6. This is P0. The growth rate is 5%. Here I have G. What's the firm's cost of equity? So I need to compute RE, the cost of common equity. Here I need to apply the formula that relates to dividend growth model because I have all of the required information to apply the formula. So this is D1 divided by P0, 0.8 divided by 19.6 plus 0.05, and the answer is 9.08%. Now for number 12. So here we have a stock currently priced at 18.53. This is P0. The company just paid $1.25 per share. So this is D0. The dividends have been increasing by 2.5% and are expected to continue doing the same. So the growth rate is 2.5%. So still I'm going to apply the dividend growth model. However, this time I need to be careful because I have D0 instead of D1. So RE equals D0, 1.25 times 1 plus the growth rate, so 1.025. This will give me D1 divided by the price, 18.53, plus the growth rate, plus 0.025, and the answer is 9.41%. Now for number 13. Southern Home Cooking just paid its annual dividend of 0.65. So once again, I have D0 because just paid. So here I will write aside D0 equals 0.65. The stock has a market price of $13. So P0 equals 13. Beta is 1.12. The return on the US Treasury bill is 2.5%. Now, US Treasury bills are considered a proxy for the risk-free asset. So whenever you see the return on the US Treasury bills is equal, let's say, to 2%, this means the risk-free rate is 2%. So here I can say that RF is equal to 2.5%. The market risk premium, which is RM minus RF, is equal to 6.8%. What is the cost of equity? So as you can see here, I have information that relates to the dividend growth model and information that relates to the capital asset pricing model. However, I will be applying the second model in order to estimate the cost of equity, because here there's some missing information, because here I don't have the growth rate. The growth rate is missing. And by the way, for problem number 13, this question can be formulated in the following way. You have all the given. Here, instead of asking about the cost of equity, let's say you are asked about the growth rate, assuming that the two models give you the same estimate for the cost of equity. So in this case, you can use the CAPM to compute RE, the cost of equity. Once you have that value, you can apply it here to find the growth rate. So now I'm asked about the cost of equity. RE equals RF plus beta into RM minus RF. So this is 2.5% plus 1.12 times the market risk premium is 6.8%. And the answer is 10.12%. Okay, now for problem 14. Tidewater fishing has a current beta of 1.21. The market risk premium, RM minus RF, is 8.9. The risk-free rate, RF, is 3.2%. By how much will the cost of equity increase if the company expands its operations such that the company beta rises to 1.5? So here I have two betas. Beta 1 equals 1.21 and beta 2 equals 1.5. So I need to compute the increase in the cost of equity because of the increase in the value of systematic risk. So here I can solve twice. I can the first time compute RE1 using beta 1. I compute this value applying the CAPM formula. Then I compute RE2. And I can also do the following. So here, if I write the formulas, RE2 is equal to RF plus beta 2 times RM minus RF. RE1 equals the same thing, except for here I have beta 1 times RM minus RF. So if I want to compute the increase RE2 minus RE1, this is equal RF minus RF, those two will cancel out. I will have beta 2 minus beta 1 times RM minus RF. So here I have beta 2 is 1.5 and 1.21. And I have the market risk premium is 8.9%. I do not need the risk-free rate. I need the risk-free rate if I have applied the first approach. So for this question, even if you do not have the risk-free rate, you can still compute the difference, that the increase in the value of the cost of equity. Because if I want to compute the value each time, I will need the risk-free rate. Using that approach by subtracting directly the values, and because here I have the market risk premium, which is 8.9%, I do not need to include RF. So even if I don't have the risk-free rate, I can still compute the increase in the cost of equity. And here the answer is 2.58%. Number 15, Pfizer has a current beta of 0.81. The market return, this is RM, is 13.9. The risk-free rate is 2.2%. What's the cost of equity? So again, a direct application. Here I will have RE equals 2.2% RF plus 0.81 beta times, this time I have the market return. So this is 13.9 minus RF 2.2%. And the answer here is 11.68%. So that's it for the cost of equity. We move now to cover the cost of debt, which is mainly the yield to maturity on a bond. So number 16, we have bonds outstanding with a maturity in 15 years. The coupon rate is 6%. Interest is paid annually. Face value is $1,000. Current market price is $1,075. What's the company's after-tax cost of debt if the tax rate is 32%? So the first step, I need to compute the cost of debt before taxes. So here, this is like the payments are made annually. So I do not need to make any adjustments. So I have 15N. The coupon rate is 6%. So $60, this is the payment. $1,000, this is FV. Minus 1,075, this is PV. I compute IY. And IY in this case is equal to 5.26%. The after-tax cost of debt this is equal to 5.26 times 1 minus T, 1 minus 0.32, and the answer is 3.58%. Now I move to problem number 17. Handyman Incorporation has 0 coupon bonds outstanding. So the coupon rate is 0. Maturity is in 8 years. The bond have a face value of $1,000. Current market price is $640. I need to determine the company's pre-tax cost of debt. So this is mainly the yield to maturity. So now I have 8 is N, 1,000 this is FV, and minus 640 this is PV. I simply compute IY, and IY in this case is equal to 14.29%. Number 18 relates to the cost of preferred equity. So here we have Grillworks and more pays a $7 preferred dividend. So this is D. The preferred stock is currently selling for $49 a share, and the market rate of return is 14%. What is the firm's cost of preferred stock? So here I applied the formula RP equals D divided by P0. So this is 7 divided by 49. The answer is 14.29%. The information that I have here about the market rate of return, that is 14%, this may only be used in the case of common equity. I do not need this information when I have preferred equity. So this information in this problem is not relevant. Now number 19. This is here an application, like the applications on the weighted average cost of capital. And number 19, we start by computing the weight of one of the components of the capital structure of the firm. So here we have Nelson's Landscaping has 1,200 bonds outstanding that are selling for $990 each. The company also has 2,500 shares of preferred stock at a market price of $28. The common stock is priced at $37, and there are 28,000 shares outstanding. What is the weight of the common stock as it relates to the firm's weighted average cost of capital? So I need to determine the weight of common equity. So the first step is to determine the value of the firm. The value of the firm is equal to D, the market value of debt, plus P, the market value of preferred equity, plus E, the market value of common equity. D equals 1,200 times $990. So this is equal to 1,188,000. The market value of preferred equity is 2,500 times 28. So I have $70,000. This is the market value of preferred equity. And finally, for common equity, it's 37 times 28,000 shares, and the market value of common equity is $1,036,000. So once I have the three values, I can compute the market value of the firm, V. V is equal to $2,294,000. So the weight of common equity equals 1,036,000 divided by 2,294,000, and the answer is 45.16%. Now I move to problem number 20. Philips Equipment has 80,000 bonds outstanding that are selling at par. Bonds with similar characteristics are yielding 7.5%. So here I directly have the pre-tax cost of debt, or the yield to maturity. So I can say here that for debt RD is equal to 7.5%. The market value of debt is equal to 80,000. The bonds are selling at par. So each bond, the price of each bond is $1,000, which is the face value. So this is 80,000 bonds times 1,000. This is equal to $80 million. This is the market value of debt. Now, the company also has 750,000 shares of preferred stock and 2.5 million shares of common stock outstanding. The preferred stock sells for $65 a share and has a yield of 7%. The yield on the preferred shares, this is the cost of preferred equity, because to compute the dividend on those preferred stocks, I simply need to multiply 7% times $65. This will give me the value of the preferred dividend. So for preferred equity, the cost of preferred equity is equal to 7%. The market value of preferred equity, P equals 750,000 shares times $65, the price per share. And the answer is $48.75 million. Finally, I move to common equity. So now the common stock has a beta of 1.34. It sells for $42 a share. The US Treasury bill is 2.8% the yield on the US Treasury bill, so this is RF. The return on the market is 11.2%. So now I can compute RE. This is equal to RF, so 2.8% plus beta 1.34 times, here I have the return on the market RM, times 11.2 minus RF minus 2.8%, and the answer is 14.06%. Now, the market value of common equity, E, this is equal to the number of shares outstanding. Here I have 2.5 million shares. The price per share is $42. So 2.5 million times 42, the market value of equity is $105 million. So now I have all of the information I need to compute the firm's weighted average cost of capital. So this is the formula. The weighted average cost of capital equals WD RD times 1 minus T plus WP RP plus WE RE. Of course, here I have first to compute V, which is D plus P plus E, and this is 233.75 million. So now the weight of debt is 80 divided by 233.75. This is the weight of debt times 0.075 times 1 minus the tax rate, so 1 minus 0.38 plus the weight of preferred equity, this is 48.75 divided by V, 233.75 times 0.07, and finally plus WERE, the weight of common equity is 105 divided by 233.75 times 0.1406. And the answer for the weighted average cost of capital is 9.3%. So this is an extended example that relates to the weighted average cost of capital. Now for the last problem, 21. Central Systems desires a weighted average cost of capital of 8%. So here I have the WACC is equal to 8%. The firm has an after-tax cost of debt of 5.4%. So this is RD times 1 minus T is 5.4. The cost of equity RE is 15.2%. What debt to equity ratio is needed for the firm to achieve its targeted weighted average cost of capital? So I need to find the debt to equity ratio. So this is mainly the weight of debt divided by the weight of equity. So using the WACC formula, I have the following. The weighted average cost of capital is equal to the weight of debt times RD times 1 minus T plus WE times RE. So here I have the weighted average cost of capital. I have RD times 1 minus T and I have RE. Now, an additional piece of information that I have is that the sum of weights is always equal to 1. So I have WD plus WE, this is equal to 1. So let's say that WE is equal to X. The weight of debt is going to be equal to 1 minus X. So now I have the following. The weighted average cost of capital is 8%. So I have 0.08 equals WD is 1 minus X. The after-tax cost of debt RD times 1 minus T is 5.4%, so 0.054 plus WE is X, so plus X times 0.152. So I have 0.08 minus 0.054 is equal to 0.152x minus 0.054x. So here I can find that x is equal to 26.53%. This means the weight of equity is 26.53%. The weight of debt is 1 minus X or 1 minus WE. So this is 73.47%. So the debt to equity ratio, which is WD divided by WE, this is equal to 73.47% divided by 26.53%, and here the answer is 2.77. So this is our debt to equity ratio.